for October and November, which is going to be around the time when the repocalypse happens, which could cause a little bit of a liquidity crunch both in gold and silver. But this is completely normal. As gold and silver rise and as the dollar dies, yes, the prices of gold and silver go higher, but that is only the base of the pyramid. The other signs are that the evil that has infected all of our systems because of the inflation that funds everything and all of this garbage, it is unmasking itself, it is unperturbed, and it is coming out in the open as devil-worshipping evil. So the point is to spend your stacks once the end game hits, and that is what saves society. It's not to accumulate gold and silver for their own sake, because really, they have very little of their own sake, other than they look nice. They're used for trade, and that is the point.
In today's news recap, Morgan Stanley raised its gold price forecast for the fourth quarter to $3,800, favoring gold, silver, and copper futures. Morgan Stanley published a report on the metal industry stating that a further weakening of the U.S. dollar should provide a tailwind for commodities. An increase in U.S. inflation could also attract inflows, and any stimulus policies from China would be an unexpected bullish factor for the industry. However, U.S. tariffs pose growth risks as the effect of stockpiling gradually fades. The bank prefers gold, silver, and COMEX copper futures. The bank expects tariffs on certain countries to be raised again starting August 1st, and tariffs on industries such as steel, aluminum, and copper may also affect and push up cost inflation in the industrial sector. Exports continue to support Chinese metal demand, but this support may weaken as tariff suspensions end. Morgan Stanley believes that the trends in the metal market this year will continue with upside potential for COMEX copper, gold, and silver, but platinum is expected to stabilize after a roughly 50% rise. The bank has raised its fourth quarter target price for gold to $3,800 per ounce, supported by central bank and investment demand driven by a weaker dollar ETF bid and ongoing uncertainty, while jewelry demand may recover as consumers adapt to higher prices. The bank forecasts gold prices $3,800 per ounce in quarter 4 2025, marking a multi-year top as the bank expects $3,500 per ounce in quarter 1 2025, 2026, and $2,500 per ounce for the full years of 2026, 2027, and 2028, respectively. However, Morgan Stanley also points out that there are many uncertainties in the industry. Key issues include the path of U.S. tariffs on specific countries and metals, the outcome of the U.S. Section 232 investigation into critical minerals, and whether China will introduce more stimulus measures. Now, we'll show you the best clips of the latest interviews, but first, smash the subscribe button and turn on notifications so you do not miss out on our recaps. And check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trading the gold-silver ratio and increase your ounces. With this easy-to-read book, you'll know everything you need to know to stack efficiently so you don't have to rely on market commentators. Enjoy the episode.
So this is a chart of the bank reserve change week by week. The change in bank reserves, these are the dollars that fund the repo market. So I've highlighted the last four third weeks of September following September 15th. September 15th, 2019, actually September 17th, 2019 was the previous repocalypse when the repo market froze up and QT had to be reversed for QE. Once again, that was 6 years ago, September 17th, 2019. Now, these are the four Septembers, September 22nd, September 21st, September 20, September 18th in the 2021 to 2024, respectively. It shows you the weekly fall in bank reserves at this time. The reason that bank reserves fall during the third week of September after September 15th is that September 15th is a corporate tax day, so the Treasury vacuums a lot of money out of the banking system into its own pocket, into its own bank account at the Fed, which is not part of the banking system. Also, you have auctions, Treasury auctions clearing on September 15th or 16th or one of those days, and that also vacuums money out of the banking system and into the treasury. So these past 4 years, we've had September 22nd, 2021, a fall of 106 billion, and then the next year a fall 155 billion, and then 166 billion in 2023, and finally 142 billion or 143 billion on September 18th, 2024. The average of all these numbers is $142.692 billion. And now you'll see the importance of these numbers in a second, but I'll just tell you that bank reserves are now at about 3.15 trillion or something like that. So if you take it down an average 142 billion, you take it down to about $3 trillion. Why is that important? Because this is what causes repocalypse. The blue line is the amount of reserves in the system. The red line is the volume of secured overnight financing of repo trades that happen every night. If this blue line and this red line meet, you get a repocalypse, or if they get close enough, really, because they're not going to meet exactly. But this was the last repocalypse over here, and you can see reserves started to rise over here because they restarted QE after ending QT when repo rates went to 10% over here when the red line got really close to the blue line. So you can see that is happening again. The last repo volume that we saw was 2947, 2.947 trillion, and reserves are now just below 3.2 trillion. So if we take away what was this average number, it was $143 billion. So if we take $143 billion away from 3.2 or 3.15 trillion it is now, then we're going to hit $3 trillion. While this number keeps rising, they're going to get close enough that they're probably going to cause some kind of repo crunch. And then the question is, what happens then? I don't think it's going to lead to an immediate crash of everything because the Fed is going to step in almost immediately and alleviate it, but it means that the money printing presses are going to restart and gold and silver are probably going to respond pretty well after maybe a brief sell-off once the apocalypse hits. Here is the ratio chart that I show often. This is the ratio of reserves to repos every night. September 6, 2019, they were at 84.6%. We are now at 88.8%, above the previous apocalypse level, so it should happen at any time now.
Silver price news targets $41, $47, and $66 as Fed liquidity sparks bullish momentum. The precious metals market is buzzing with excitement as silver emerges from a prolonged consolidation phase. After months of sideways trading, technical indicators are aligning with macroeconomic tailwinds to create what many analysts are calling a perfect storm for silver bulls. With the Federal Reserve potentially shifting gears and inflation concerns mounting, investors are eyeing silver as both a hedge and a growth opportunity. First target, $41. This breaks silver out of its current range and confirms the bulls are in control. It's not just a number, it's a statement that the consolidation phase is officially over. Second target, $47.6. Here's where things get exciting. This Fibonacci extension level represents serious momentum territory. A push to these levels would grab headlines and pull in momentum traders. Third target, $66. Now we're talking about a completely different silver market. This long-term projection would represent a fundamental repricing of the metal, putting it in rarefied air not seen in over a decade. Dream scenario for metals investors. Everything's lining up for what precious metals enthusiasts have been waiting for. Fed policy pivot, check sticky inflation, check economic uncertainty, check it's like a checklist for precious metals outperformance. Now, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. And go to goldsilverstacks.com to get the Numismatics Handbook, the perfect guide for stackers who want to get active trading gold and silver coins instead of selling their gold and silver bullions for fiat. Enjoy the episode.
If it happens in September, which I think is likely, though, of course, it's not 100%, and I could be totally wrong about everything I'm saying now because this is really new territory for everybody. The monetary system never really dealt with this before, so everyone's just kind of making it up on the fly, including me. You have here the October 1979 sell-off of gold of 16.5%. In October, we hit a high, October 1979, I think it was October 1st, 1979, or October 2nd, the first business day of October, basically. Gold hit what looks to be about $455 and went down to about $380 by the 1st of November. That was a monthly sell-off of about 16.5%. People thought that the gold rally was over, but no, it was not. It was only just beginning. It went from $380 to about $872 in about a month and a half, or about 2 months actually. This knocked off a lot of people. Don't let this October knock you off. We could see a sell off if the liquidity crunch is allowed to continue for a little bit, but don't freak out about it. It has happened before. We've had bad months, even in 1979, which was the best year for gold ever. In silver, you could see what happened in the same month, October to November 1979. Silver was more static for a longer period of time. For about 2 months, it didn't move. As gold moved starting in November, silver did not. For 2 months, it traded within about $18.50 to $16, $62.50 in that range, and then from there, it went from about $18.50 to $50 in about a month and a half to 2 months, or whatever that is. So don't be afraid of static silver or a sell-off in gold in October following a repocalypse. I'm not saying it's going to happen, but if it happens, it's completely normal. And here is the surprising chart. This is 1980. Remember, the gold peak is over here at the beginning of the chart. January 1980, about January 21st, 1980, it's about over here, maybe over here. Exactly where it is, I don't know, because I don't want to count these candles, but you can see the main rally, the big rally in homestake mining, the premier gold stock back at that time, happened starting in May of 1980 and moved from about $7 to $22, about tripled during 1980 after the gold peak had already happened. So there's another incentive to get some gold mining stocks because you don't know when exactly they're going to rally. They don't necessarily trade in line with gold and silver all the time. So it is one way to gain exposure to rising bullion prices. And the final thing I want to talk about as to a very obvious sign that the end game is almost here.
What do you think of Rafi's take? Do you agree that silver is still massively undervalued and that a return to the 1980 Dow to silver ratio could drive it toward $2,400 an ounce? Or do you think this big reset scenario is overblown? Is it a coming reality? Or just wishful thinking and market hype? Post your honest opinion in the comments below and share your own gold and silver price predictions with the stacker community. Now, check out this next video right here. It's the perfect follow-up for you. I'll see you on the other side.